Well, chaps, what's going on? Today we're going to make a quick video, and I'm just going to discuss the 1 to 3 ratio spread that I've been looking into quite heavily, and I'm going to start implementing into our account, as well as providing you guys with these trades too. I'm about to go to the gym, by the way, hence the look. So you're going to have to deal with that, but it's fine. So just got the webcam sorted. I'm actually using my camera. Fuck me, I battled for hours yesterday trying to get this fixed. And I finally got it done, so now I can actually make proper YouTube videos. So what we're going to discuss today, as I said, is the ratio spreads and why I think they are going to be very effective for us on the futures account. So we're not talking about our stocks account today at all. It's just purely the futures. So what our goal here with these is to, number one, collect premium, because that is what we do. We collect premium, as you guys know. So I want to collect as much premium as possible and try and get that theta as high as possible. But also we need protection, because as we know, these are naked positions. Technically they're naked positions after a point. So let's get straight into showing you guys what this is. Enough of the fucking chit chat. So for this example, let's go 120 days out. No particular reason, just 120 day. I don't have any open positions on, so we can kind of look at this properly. So to set this trade up, what you guys are going to want to do is you're going to want to sell 3 puts. So let's just do the 4,000 strike for this example. So we've just sold 3. Now what we're going to do is we are going to buy 1 at a higher price. So as you can see, this is collecting us right down here. $1,208 is what this is bringing in premium. And as you can see, this is a 0.02 delta, a 99.5% probability of profit. Sounds good to me. Way out of the money. So what we're going to look at is, let's try and buy slightly higher. Let's buy a 4,400. Okay, now we're going to drop this down to 1. Now what you can see is this trade is now still bringing in $513 through the door. That is fantastic. As you can see, our probability of profit still 99.2. This has us hedged. Okay, so the way this is going to work now, the way this trade works is we collect $512 or $513 no matter what the market does. If it goes up, if it goes flat, if it comes down a bit, we have just collected $513. However, this is where this trade gets good and interesting. If the market was to breach our strike, and if we come the whole way down here, what you can see, if we end up in between these two, then we start to get into our max profit range. And if the market at expiration was to close exactly at 4,000, we make $20,500 max profit. That is madness. That is why this is so powerful. It's going to hedge our account out massively. Now, enough of that. I'll come back to that in a little minute. What I want to discuss though is, because we've sold 3 of these puts, what we can do is we can actually close these out once they have made enough profit to pay for this. Now in this case, that's not really going to work very well, because we ended up paying about $500 for this, and these here were about $500 combined as well that we brought in. So if we actually drop this down a couple strikes, you'll see now that we're not paying as much for this. If we can close this position out, we can close these sold puts out, and then this will be free. This will be a free put. The 4,200 will be a free put that we've bought. I don't know if I'm explaining this in a very simplistic term for you, but basically, if this leg brings in 8 credit each, okay, so let me get my calculator out and break this down for you. If this leg here, the sold leg, brings in 8 credit each, so we're going to type in 400, because that's, it's a 0.50 multiplier, so 400 times 3. So this leg of the trade brings in $1,200. I'm just rounding it. Okay, and this one costs 10 credit, which means that costs, if I minus, we are going to minus 500, because that's what this costs. So that's $700. Okay, so as you can see right down here, extrinsic 688, so that's 700. So that lines up. Now, but what we can do is, because this only costs 500, but this is paying us, what was it paying again? This is paying us 1,200, but this costs 500. So what we can do is once these sold puts have decayed about $500 worth and they are in $500 profit, well, what we could do is then we could close these out for $500 profit, meaning technically we paid nothing for this. This will have been a free put that will hedge our account out with max profit of $209,000. Obviously the market isn't going to zero, but if anything was to happen, then you've literally got a free bought put. So below this strike, you print in a market crash. That would hedge our account out massively. Now, let's just go back to the 4,500 strike, and I'm still going to sell. In fact, sorry, we'll go back to the 4,500 for the buy side, and we're going to go to the 4,000 for the sell side. And I'm going to just show you guys what this brings in. So as you can see, in fact, let's go to 44. There you go. So it's bringing in 525 through the door. This was the original one I showed you guys. 20,500 max profit. So let's go to our curve and we're going to have a little look at what this actually looks like. So we're going to go analysis on. Right. And then we are going to turn off everything apart from that ratio spread. Okay. Here we go. Right. I'm going to zoom out. So this is what that there is going to look like if I just go back in this way. So what this is going to look like, you can see right here that our P&L at expiration is 1,200. In fact, what's going on here? This isn't right. There's something else. Something else is working here that shouldn't be. There we go. That's it. That's it, looking better now. So if I zoom out, let me just show you what the P&L curve is going to look like. It's going to look like this. So, in fact, let me zoom out some more. Okay, it's going to look like this. So you've got your flat P&L here. If you look at the profit and loss at expiration, it says we're making 525 at expiration the whole way along here. The whole way along here, we're at 521 at expiration. And then look, we have this big spike. So if the market was to fall, here's our 2 standard deviation point. Below our 2 standard deviation, as you can see, it starts to absolutely print. You can see we're going all the way up here. Look, there's $20,000, 20,500. And then your break-even point on this trade is actually all the way down at, where does that may come down to get it exact? There's your break-even there, 37.95 on ES. Fantastic trade. Obviously below that you have an infinite loss. But you know that is way, way, way below the 2 standard deviation point, and you've got this massive, massive big temple here of huge profit to hedge the account out. Absolutely huge. This is why I absolutely love this. Now I'm going to go very in depth in some of these trades. I've actually got one open right now on Micros Oil. Let me find it now. See, here we go. So I've done this exact thing. If ThetaGand's going to load for me, that'll be fantastic. I think we're going to crash, lads. Yep, ThetaGand just crashed. So that was a very good introduction anyway, per se, to this. We're going to go a lot more in depth in this. I'll probably have another couple of videos coming out within the next day or two. And I'm going to show you every single move I make, every modification I make, when I make them free. Everything, as you guys know, is going to be in the Discord, and our goal is to collect premium and make safe, consistent cash every single week, every single month. Thank you guys. See you in the next one.